let's start off with Baba, because expectations were pretty low. So it was a beat, but kind of give us some context as to how good these numbers are.
Yeah, it was a bit of a sigh of relief, obviously, for global investors who have stuck with Alibaba and its decline. Obviously, the stock has been down about 30% already year to date and been hammered since the regulatory crackdown began on it and its affiliate Ant in the autumn of 2020. So the shares rose almost 15%. Baidu, I'll get to that in a minute, they were also up 14%. And there were a couple of big beats. Well, not big, but beats. And that's how the bar has been kind of set so low. You can see that revenue was up about 9%. The estimate was for 7.1% increase in revenue. So, you know, after Tencent disappointed the market a week before with just eking out revenue gains of 0.1% when they were expecting 4.6%, Alibaba's beat was a positive. Also on adjusted net income, if you strip out those investment losses, you had a beat, as you can see on your screen. So adjusted net income was up, revenue was up, and the stock was up. But, you know, there's still a lot of headwinds for Alibaba. We do not have much clarity on the path forward for an easing of regulatory concerns, even though government officials have talked up the platform economy. They have not necessarily delivered a timing on when a rescue will be allowed or what kind of policies will come down the pike. Also, competition has been absolutely heating up since the anti-monopoly campaign began to whittle down the real competitive advantage that Alibaba had in e-commerce. Can I bring up a Bloomberg terminal chart? We'll go into the Bloomberg terminal 6185. You can see how gross margins have been squeezed over this time period at Alibaba. That is not the chart, but essentially you can see how the competition versus Pinduoduo, versus Meituan, versus JD.com. The blue line there is PDD, Pinduoduo, beating Alibaba on the gross margin front as Alibaba's margins have come down. The other headwinds, obviously, are going to be the COVID situation in China, where retail sales plummeted in April. So this current quarter could be even worse than the first quarter, you know, because Alibaba has refused, like it always does, to give a current fiscal year revenue outlook. And this is where CEO Donald Zhang weighed in. He says in April, there's been significant pressure on, of course, Alibaba's business. He is seeing some improvement in the COVID situation in Shanghai in particular, but considering the risks and uncertainties arising from COVID-19, which we are not able to control and are difficult for us to predict, we believe it is prudent at this time not to give financial guidance. One side note, Ant Group also contributed about $1.1 billion to Alibaba's earnings. Ant, though, reports its report card a month later than Alibaba. So this report card from Ant was from the calendar fourth quarter through December, but still, it was a slight increase from year-over-year levels of 1.3%. So Ant contributing. So there's a little bit of good news down the line of this report card from Alibaba, but is it enough to put a floor on the stock fall?
What about Baidu?
Baidu is a similar story. It beat expectations. Baidu really focusing in on artificial intelligence investments, cloud computing, autonomous driving gains, offsetting weak ad sales. Weak ad sales is to be expected given the lockdowns in like the commercial center of China, that being Shanghai. Sales rising, eking out again, 1% rise to $4.2 billion US. There was a net loss. Again, like Alibaba, the net loss was hurt by investment losses. They've stopped as well. Baidu has stopped as of the calendar fourth quarter giving full year guidance or revenue outlook. Simply, it's too uncertain to predict. And iQIYI, which is the affiliate of Baidu, it listed in the United States. It posted its first profit, net income gain since that IPO in 2018. iQIYI, it's the Netflix-style video service of China. It is on aggressive cost controls, and those will likely continue.